Do you know why every time the yield curve inverts, the world faces a crisis 12 to 18 months later? Listen, I'm going to tell you straight up a truth that 99% of people have no idea about. There's a forecasting tool so frighteningly accurate about economic crises that it has correctly predicted the Great Depression of 1929, the dot-com crash of 2000, the 2008 financial crisis, and most recently, the COVID recession of 2020. This tool is called Yield Curve Inversion. Have you ever wondered why the big players on Wall Street always know when to sell off and when to buy in? Why do they always escape the top and accumulate at the bottom? The answer lies in this very tool. Today, I'm going to expose the true nature of what the yield curve really is. Why, when it inverts, the economy collapses within 12 to 18 months, how the financial elite use this signal to harvest your assets, and most importantly, how you can protect yourself. After reading this, you'll never look at financial markets the same way again. First, let me clarify this concept with a simple example anyone can understand. Imagine you're lending money to your best friend. If you lend for 1 week, you'll charge a low interest rate because there's little risk. But if you lend for 10 years, you'll demand a higher interest rate because who knows what will happen in 10 years. That's the basic logic of the yield curve. Under normal conditions, long-term bond yields like 10-year and 30-year will be higher than short-term rates like 3-month and 2-year. When plotted on a graph, we get an upward sloping curve, and that's a normal yield curve. But here's what they don't want you to know. The yield curve doesn't just reflect risk, it reflects the psychology and expectations of the entire financial system. The truth is that central banks, especially the Federal Reserve, can manipulate this yield curve easily. They control short-term interest rates through monetary policy, while the market determines long-term rates. When the Fed raises short-term rates too fast and too aggressively, a strange phenomenon occurs. Short-term rates start exceeding long-term rates. The curve becomes inverted, and that's when the alarm bells start ringing. Yield curve inversion isn't a random phenomenon. It's the result of a deliberate chain of decisions from central banks. When the curve inverts, it signals that investors are panicking about the near-term future. They're willing to accept lower yields for long-term investments, and this only happens when they believe the economy is about to fall into recession. In other words, yield curve inversion is the market's way of casting a vote of no confidence in the economy. Let's look back at history to see this isn't coincidental. Before the Great Depression of 1929, the yield curve had inverted in 1928. Exactly 12 months later, the stock market collapsed 90%. Millions lost their jobs. Banks failed en masse. But do you know who escaped? Those belonging to the financial elite. They had quietly sold off before the collapse occurred. In early 1999, the U.S. yield curve inverted again. The result? The dot-com bubble burst in 2000. Thousands of tech companies went bankrupt. The NASDAQ lost 78% of its value. Once again, the big players knew in advance and escaped the peak. In August 2006, the U.S. yield curve inverted. Exactly 18 months later, the global financial system collapsed. Lehman Brothers went bankrupt. Millions lost their homes and jobs. But what about Goldman Sachs, JP Chase, and other giants? They not only survived, but became stronger after the crisis. At the end of 2019, the U.S. yield curve inverted strongly. COVID was just the perfect excuse for the recession that had been predicted. Do you see the pattern? Every time the curve inverts, 12 to 18 months later comes a crisis. To understand why yield curve inversion predicts recession, you need to understand how banks make money. Banks' business model is simple. Borrow short-term from your deposits, lend long-term like mortgages and business loans. The interest rate spread is their profit. For example, a bank pays you 2% on savings but lends to businesses at 8% interest. That 6% difference is profit. But when the curve inverts, what happens? Short-term rates are higher than long-term rates. Banks start losing money on every transaction. The domino effect begins when banks can't make money. They will tighten lending, making it harder to get loans, raise lending rates, making it difficult for businesses to access capital, and cut staff, increasing unemployment. Businesses can't borrow money, leading to reduced investment, cut production, lay off workers, people reduce consumption, businesses sell less, and the vicious cycle begins. That's how a signal from the bond market can bring down an entire economy. While ordinary people panic and sell off assets, who are the ones quietly accumulating? Large investment funds, investment banks, financial dynasties. They have enough cash because they sold earlier to buy back assets at dirt cheap prices. Every crisis is an opportunity for them to strengthen control and accumulate more assets. In March 2022, the Fed began raising rates from near 0% to 5.5% in just 18 months, the fastest pace in history. In July 2022, the U.S. yield curve officially inverted, with 2-year rates higher than 10-year rates. In late 2023 and early 2024, we witnessed the collapse of Silicon Valley Bank, Credit Suisse's bankruptcy, numerous regional banks struggling, and the real estate market beginning to decline sharply. What's notable is that this time, the Fed intervened very strongly to prevent the crisis from spreading. They pumped trillions of dollars into the system to save banks. But this is just delaying, not solving the problem. As I often say, you can't print money to solve problems caused by printing too much money. By June 2025, the U.S. yield curve is still inverted. This means the time bomb is still ticking. Some concerning signs include U.S. government debt reaching a record $34 trillion, inflation still above the Fed's target, the labor market beginning to show signs of slowing, and regional banks still struggling with commercial real estate portfolios. When professional investors see the yield curve starting to flatten and preparing to invert, they implement a 3-phase strategy. The preparation phase, 6-12 months before crisis, they begin gradually selling high-risk assets like tech stocks and real estate, accumulate cash and gold, buy long-term government bonds. The waiting phase, when the curve inverts, they continue selling off, look for opportunities to short the market, and don't buy anything until the crisis occurs. The harvesting phase, during and after crisis, they buy back assets at dirt cheap prices, invest in companies with solid foundations but being sold off, and patiently wait for market recovery. While the big players follow the above strategy, retail investors often make mistakes like not knowing yield curve signals because they only hear news from mainstream media that's often filtered, suffering from FOMO when markets are still rising, so they rush in, selling off when it's too late, meaning only selling when markets have already collapsed, and having no cash to buy the dip because they went all in earlier. Do you find this familiar? That's exactly how the system is designed to transfer money from the poor to the rich. To protect yourself, you need to know how to monitor the yield curve through important indicators like the 10Y2Y spread, which is the difference between 10-year and 2-year bond yields, and the 10Y3M spread, which is the difference between 10-year and 3-month bond yields. How to read signals. When spread is greater than 1%, the economy is healthy. Spread from 0 to 1% needs caution. Spread less than 0, meaning inverted, then prepare for recession in 12 to 18 months. Reliable information sources include FRED, Federal Reserve Economic Data, Bloomberg Terminal, for those who can afford it, and Yahoo Finance, which is free and easily accessible. The truth is, yield curve inversion isn't a forecasting tool, but a plan being executed. Central banks know full well that when they raise rates too fast, the curve will invert and cause recession. They're not fools, but the smartest people in the world about finance. So why do they still do it? Because that's exactly the purpose. Every boom-bust cycle follows a similar script. Pump money to create bubbles with low rates and cheap money. Let bubbles inflate as people borrow to buy assets, light the fuse to burst bubbles by raising rates, creating yield curve inversion, and harvest assets by buying back at cheap prices when everyone panics. They create the problem, then sell you the solution, and you pay for both. Behind the Fed, ECB, Bank of Japan, aren't governments but private banks and financial dynasties. Names like Rothschild, Rockefeller, JP Morgan aren't just history. They're still controlling central banking systems through shareholders and boards of directors. Every time the yield curve inverts, it's not a natural disaster, but a harvesting plan executed perfectly. Now that you understand the nature of the game, how do you protect yourself? Rule number 1, don't play by their rules. Instead of trying to beat the market, learn to live with the cycle. Understand that everything has cycles, and this cycle is controlled by the yield curve. Specific strategy. When the curve is normal with spread greater than 1%, you can invest in risky assets like stocks and real estate, but always keep 20 to 30% of assets in cash or gold, and don't over-leverage. When the curve starts flattening with spread from 0.1%, start accumulating cash, gradually reduce risky investments, and mentally prepare for recession. When the curve inverts with spread less than 0, actively accumulate cash and gold, stay away from all high-risk investments, and patiently wait for buying opportunities. The hardest part isn't understanding the yield curve, but controlling emotions. When the curve inverts but markets keep rising, you'll feel like you're missing opportunities. That's when you need to remember, the patient one ultimately wins. When crisis hits and everyone panics, you'll feel fear. But that's exactly when you need to be brave and buy in. Advice by age group. Ages 20 to 30, focus on developing skills and increasing income. Learn about finance and investing. Accumulate initial capital, can accept higher risks because there's more time. Ages 30 to 50, diversify investment portfolio. Closely monitor yield curve to adjust allocations. Focus on income-generating assets like rental real estate and dividends. Always keep 6 to 12 months of living expenses in cash. Ages 50 plus, prioritize asset preservation over growth. Increase allocation to gold and government bonds. Reduce allocation to stocks and real estate. Have specific retirement plans. After reading this far, you understand that yield curve inversion isn't prediction but a plan. Every crisis can be predicted 12 to 18 months in advance. The elite always know beforehand and prepare. The system is designed to transfer assets from poor to rich. But most importantly, you now know how to protect yourself in this game. I need to emphasize, this isn't specific investment advice. Everyone has different circumstances, different risk tolerance levels. My purpose is to help you understand the system's true nature so you can make wise decisions for yourself and your family. The most important things you can do today: monitor the yield curve weekly by setting reminders to check the 10Y2Y spread. Build an emergency fund of at least 6 months of living expenses. Never stop learning because finance is a survival skill in this era. Create multiple income streams and don't depend on just one source. Share knowledge to help awaken those around you. The global financial system isn't designed to serve you, but to exploit you. But when you understand the rules of the game clearly, you can protect yourself and even take advantage of opportunities the system creates. Yield curve inversion is just one of many tools the elite use. When you learn to read these signals, you'll stop being prey and become a real player. Don't let them continue deceiving you. Wake up and take action. If this article is useful, share it to awaken more people. Because financial knowledge isn't just power, it's freedom. Remember, in the financial world, those with information will always beat those without. Now you have the information. Use it wisely.